this company Rumble. So they have a goal of getting to this break-even level of ebitda. But the problem is two things. One, it's global monthly active users metrics. It isn't even reliable, as stated by the company. If you read their, I don't even think I have it open. But if you read their filing, they tell you it's unreliable. But let's just assume it's facts for now. And then look at the ARPU. It's just directly related to their audience monetization segment. And you can just see how low it is. And here's why they won't get to this break-even level of ebitda. At least I don't think they will. So right now they have, let's assume this is facts, 59 million of users, monthly active users at that. Their cost of sales, the cost to deliver the content is $30 million, right? So if you just take the $30 million over the monthly active users, this says you need about 51 cents in ARPU, average revenue per user, 51 cents. That's 50% higher than their current level of ARPU right now. Okay. And that's just to get to gross margin of 0%. Right now, you can see over here, the gross margin is 27%. So to get to 0%, they would have needed 51 cents of ARPU. Well, they're saying they want to cover all this though. G&A, R&D, S&M, all of these things. And it costs them about $55 million to run the business. This covers the cost, G&A, the R&D, the sales and marketing. But if you do the same math, if you spread the 93 over the 55 over the 59 million users, they need 93 cents of ARPU. And that's, I mean, come on. They're at 34 cents now. They need to get to 93. You can see. This is like 3 times the number of 3 times as much ARPU as they have now to break even. It's crazy. And I mean, there's really no scale in the business. You see, what's this? 40% roughly. Maybe it's less. Let's see. 4% of this. They got this point in time revenue, which is roughly 40% of total revenue. So that means that, this starts at 0 every single quarter. But this is a substantial part. And honestly, this is a tech company. It shouldn't even be valued on this portion of revenue anyway. So really, their revenue was 14 million, right? And last year they really did 59 million, truthfully. Because this stuff is one-off, but it's helping them right now. But even over here in this simple model I created, let's say they get to $122 million in 2025 revenue. I'm saying, okay, well, they could trade eight times EV on that. They have some cash in the bank, 0 debt, market cap 1.3 billion. They got shares outstanding, and I'm saying they're worth about $3. But here's the fun fact. If I just do the same math on only the recurring piece, which I think should be done that way, 72 million, and of course they can get a higher valuation on that, but still much less than the $8 right now. And the street is saying that they're trading around like 28, basically $8 a share. I just don't think this is true. I think the company is in a bad situation. You can look at the balance sheet, 301 million, but this was effectively a tender offer. They did a deal with Tether for $700 something million, and they then bought, I think, $500 million of shares, as in buybacks, as a tender offer. So this is net of that. So they got a cash influx, but at the current run rate of cost, if you take out, honestly, 55 million, they're gonna need cash again next year, basically. So yeah, I think this is a short. I think this is a problem with the business. We'll see.